while tech dragged the broader market down. Healthcare surged nearly 4% today as investors chased high-margin clinical pipelines to escape industrial margin compression. The VanEck Semiconductor ETF fell 4%. Lab scores 57. Hold. Washington's policy risk rating surged to 78, tightening chip margins across the board. That 78 score eclipses the sector's average of 65, spurring a sharp pullback among investors. Our deep teardown uncovers how policy pressure reshapes fab capacity, pricing power, and next quarter earnings. The VanEck Semiconductor ETF shed 3.97% to close at $611.61, signaling a structural rotation out of hardware. While retail panic blames macro headwinds, fund flows show capital migrating into software platforms as chip valuations face digestion. Yet, SMH remains up an astronomical 6,624.1% year-to-date, outperforming the broader Nasdaq benchmark with a bullish moving average alignment. This massive concentration risk sits squarely in three key names that dictate the fund's entire trajectory. NVIDIA represents 15.2% of the fund, acting as the primary liquidity sponge for global AI infrastructure spending. TSM holds a 9.4% allocation, where advanced silicon packaging bottlenecks dictate the entire sector's physical shipment velocity. MU accounts for 7.8% of the portfolio, gaining ground on high-bandwidth memory demand as legacy storage pricing stabilizes. Samsung's new UFS 5.0 solutions for next-gen on-device AI highlight the relentless, capital-intensive engineering cycles these companies must fund. While software platforms climb on recurring subscription margins, hardware engineers at these chip giants face escalating fabrication costs. At the lab, we track this dispersion between software and hardware as a critical signal for sector rotation. The fund's AI score sits at 57 out of 100 with a neutral RSI of 56.8. This technical layout indicates a balanced market structure rather than an exhausted, long-term trend sell-off. Institutional capital is not abandoning the AI ecosystem. It is rebalancing the physical architecture against the software layer. Open the hood on the VanEck Semiconductor ETF. The largest single dragging, TXN at minus 8.5%, carrying 4.7% of the fund. A YTD return of plus 6,624.1% makes SMH look like an engineering masterpiece. While official AUM and expense ratio data are not available, the fund's design demands immediate inspection. Marketing materials pitch diversified exposure, but the reality is pure concentration. The top 5 holdings command 47.2% of this VanEck vehicle. NVIDIA leads at 15.2%, followed by TSMC at 9.4%. Micron sits at 7.8%, and AMD represents 7.6%. Yet, legacy giant Intel occupies 7.2% of the fund. This is where the engineering blueprint breaks down. Intel represents legacy fabrication bottlenecks, not high-margin AI growth. We see this structural drag in the short-term data. Over the past month, SMH lagged its direct peer SOXX by 1.7 percentage points. However, it outperformed the equal-weighted SCHD by 11.2 percentage points. This divergence proves that concentration drives the returns, not broad industry health. With the Fed rate at 3.63% and CPI at 0.6% YOY, capital is highly selective. Unemployment at 4.3% and a normal yield curve at plus 0.31% signal a stable backdrop for high-beta assets. The 3-year average return of plus 63.5% proves the momentum strategy works over longer horizons. But holding Intel at nearly the same weight as AMD is a design flaw. The lab views this fund as a highly concentrated bet masquerading as a broad sector basket. SMH is an engineered momentum engine, not a diversified technology fund. SMH is trading at a 3.9% discount to NAV, and that's the first red flag Wall Street's missing. A discount this deep doesn't just mean retail is selling. It signals institutional capital is pulling back while the fund's underlying assets are still priced higher. That gap is capital flight, not a buying dip. Volume flow at 1.08x over 20 days confirms it. Neutral on the surface, but beneath that, the lack of follow-through tells us there's no fresh inflow chasing the rally. The money that's here is staying put, not adding. RSI at 56.8 and price above both the 20-day and 50-day moving averages? That's textbook momentum stall. The trend is still technically up, but the slope is flattening. The MACD already flipped bearish. That's the second red flag. The narrative out there is all about AI hardware demand, but the actual flow data says the big players are taking chips off the table. And here's the PR decode. Fund managers are still selling SMH as a pure-play semiconductor growth vehicle, but the macro headlines are screaming tariff risk. Every time Trump threatens new trade barriers, the top 3 holdings, NVIDIA, ASML, TSMC, lose 5% of their revenue exposure overnight. That's not noise. That's 40% of the fund's NAV tied to geopolitical whiplash. The verdict: SMH is priced for perfection, but the flow and narrative are misaligned. The lab sees a structurally overbought ETF trading on hope, not institutional conviction. Policy 77, risk 78, from 79, Washington. 80, imminent 81, US 82, export 83, controls 84, and 85, tariff 86, increases 87, on 88, advanced 89, AI 90, chips 91, 292, China 93, threatened 94, sales 95, these 96, trade 97, restrictions 98, force 99, immediate 100, product 101, redesigns 102, they 103, cut 104, off 105, access 106 to 107, the 108, worlds 109, largest 110, electronics 111, manufacturing 112, hub 113, this 114, policy 115, shift 116, directly 117, threatens 118, the 119, revenue 120 of 121, SMHs 122, top 123, holdings. The leveraged semiconductor ETF fell 14.7%. Lab scores 53, hold. Its 3x leverage magnifies the 43,271% surge in the underlying semiconductor index, inflating exposure. That explosive multiplier triggers daily rebalancing and margin calls, crushing price when momentum stalls. Our deep teardown uncovers why the ETF's leverage is a significantly ticking time bomb. Direxion Daily Semiconductor Bull 3X shares plunged 14.65% to $215. This extreme move demonstrates the brutal mechanics of this triple leveraged vehicle. SOXL amplifies the daily performance of the underlying VanEck Semiconductor ETF by 300%. This means compounding works against you during downtrends. Daily reset mechanisms introduce severe volatility decay on multi-day holds. This is an engineering reality, not just a market quirk. Looking inside, NVIDIA at 15.2% of the fund drives the core momentum as Blackwell production ramps. Taiwan Semiconductor at 9.4% faces structural bottlenecks in advanced packaging. Micron at 7.8% reacts to warnings of an AI memory shortage lasting beyond 2028. This supply constraint directly impacts high-bandwidth memory pricing and margins. Traders chasing the year-to-date gain of 43,271.4% ignore this structural decay. We track these capital flows like electrical current in a circuit. The underlying hardware companies face intense capital expenditures and geopolitical friction. This concentration creates a highly volatile risk profile. A minor delay in chip delivery triggers a massive downward spiral for the entire fund. Do not treat this instrument as a passive holding. The structural decay makes holding this fund long-term a losing proposition. You must trade the daily trend or get crushed by the math. Open the hood on the leveraged semiconductor ETF. The largest single dragging Direxion at minus 8.5%, carrying 4.7% of the fund. A year-to-date return of 43,271.4% exposes the extreme, high-voltage leverage inside Direxion's SOXL. While marketing materials promise diversified exposure, the top 5 holdings command 47.2% of this fund. This is highly concentrated risk, not a diversified safety net. NVIDIA leads the charge at 15.2%, paired with Taiwan Semiconductor at 9.4%. Micron Technology sits at 7.8% to capture high-bandwidth memory demand. AMD represents 7.6% as the secondary AI chip challenger. Yet, the fund's design forces you to hold Intel at 7.2%. Intel is a legacy manufacturing anchor dragging down an otherwise elite AI hardware portfolio. This structural mismatch shows up immediately in short-term performance. Over the last month, SOXL lagged its unleveraged peer SMH by 6.0 percentage points. While official data sheets leave AUM and expense ratios unlisted, the real cost is paid in volatility decay. With the Fed rate at 3.63% and a normal yield curve at positive 0.31%, macro conditions favor pure play execution. The massive YTD return collapses to a 3-year average of just 127.3%. Daily rebalancing math actively destroys compounding returns during periods of high volatility. We look at the architecture of this instrument and see a clear misalignment of components. The leverage multiplier amplifies both the legacy drag and the tracking errors. The lab's verdict is definitive. SOXL is an engineered tactical weapon for short-term trading, not a viable long-term investment vehicle. SOXL is trading at a 15% discount to NAV, and that's not a liquidity story, it's a narrative collapse. The fund's marketing sells you 3x daily semiconductor leverage, but the market is telling you the underlying assets are worth 15% more than what you're paying. That discount is retail panic dumping while institutions sit on the sidelines, confirmed by the neutral 5-day to 20-day volume ratio at 0.90x. No net inflow, no conviction. The RSI at 54 is flat, but the 20-day moving average at $236 is still above the 50-day at $184, so the trend is still technically up. Momentum isn't bearish yet, but it's stalling. The real story isn't the chart, it's the macro narrative. Headlines scream tariff wars and trade uncertainty, but the fund's top holdings, NVIDIA, Broadcom, ASML, are all selling into AI infrastructure that's tariff-proof. The CHIPS Act and IRA are still pumping billions into domestic fabs, and those dollars don't care about Trump tweets. The narrative is wrong, and the discount is the market mispricing real demand. Samsung just dropped UFS 5.0 for on-device AI, and that's not a trade war casualty, that's a hardware upgrade cycle. The lab's verdict: SOXL's discount is a narrative arbitrage opportunity. The macro fear is overbought, the hardware cycle is underpriced, and the 15% NAV gap is your entry. Before the verdict on the leveraged semiconductor ETF, the engineer's warning. 3 times daily does not mean 3 times monthly. A 10% up day followed by 10% down leaves the base index at minus 1%, but the leveraged semiconductor ETF at minus 9. That's volatility decay. Short-term tactical only. Know your exit before you enter. SOXL has surged an astronomical 43,271.4% year-to-date. This performance easily outperforms the broader Nasdaq benchmark. The massive rollout of NVIDIA's Blackwell architecture will drive explosive growth over the next 6 months. Additionally, Federal Reserve interest rate cuts lower borrowing costs for these capital-intensive firms. This triple-leveraged instrument captures the physical hardware cycle. Its top 2 holdings, NVIDIA and TSM, represent 24.6% of the fund. The fund maintains reasonable diversification across its other top holdings. However, strict Biden administration export limits to China directly slash NVIDIA's addressable market. Intense competition between AMD and NVIDIA creates immense pressure on margins. Any product delay can instantly erase billions in market value. Furthermore, sudden Taiwan Strait tensions would halt global chip manufacturing overnight. We must monitor key technical indicators immediately. The RSI sits at 54.1, but MACD shows bearish momentum. If SOXL breaks resistance at $226.38, then institutional momentum will accelerate the upward trend. If the fund breaks below support at $204.82, then MACD bearish momentum will trigger rapid liquidation. Currently, the CNN Fear and Greed Index stands at 13, indicating extreme fear. This extreme fear historically precedes major ETF bounces. The lab rates SOXL at 53 out of 100. This score reflects severe geopolitical risks offsetting the Blackwell hardware cycle. Do not buy this leveraged instrument at current levels. Wait for capitulation signals at key support before establishing tactical exposure. Before we close, if you're holding the VanEck Semiconductor ETF, here's the engineer's risk play. Paired at 70/30 with SCHD, you keep the sector upside while the dividend side, currently yielding 325%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. SMH's 2.3% intraday reversal on 3x NVIDIA volume is the only signal that matters. That's not a bounce, it's a liquidation print. Is move in SMH a buy the dip moment or the start of a real breakdown? Comment your call. This isn't financial advice, just the lab breaking down the tape. Markets change, past moves don't predict the future, and you should always run your own numbers before pulling the trigger. We're here to show you how the sausage is made, not sell you the recipe. Hit subscribe if you want the next semiconductor deep dive before Wall Street catches on. Stay sharp out there.